Let's talk about bear markets. Now, the reason we're having to do this is because at some point, somebody out there picked an arbitrary number of minus 20% as being the definition of a bear market. With the S&P 500 falling to that point, we're hearing about how we're now in a bear market. Here at SCM, we've never used that type of a number. We've actually always have looked at both how big the loss is and how long that loss takes, because that is, from a behavioral perspective, what really matters. If the market drops 20% over a couple of weeks and recovers it in the next 2 to 4 weeks or 6 weeks, that's really not a bear market, because that didn't do much damage to you psychologically, which means you probably didn't even have a chance to react. At SCM, we look at a true bear market as being one that is met with an economic slowdown. What does that look like? Typically, that is, on average, a drop of 35 to 50% that takes about 18 to 24 months. So it's not just a one quick event. And again, that comes with an economic slowdown. And if you followed along with our blog over the last year, we truly believe that the data is telling us that's the environment we're in. So there's a few things I want you to keep in mind as we go into a true bear market. First off, this is not what you're used to if you look at the last 12 years. What we've seen the last 12 years is the Federal Reserve has always been there to bail us out. Time and time again, every time the market had a little bit of a speed bump, the Fed jumped in and they changed policies. The problem this time around is the Federal Reserve is one of the reasons we're having such high inflation, which is one of the reasons we're going through an economic slowdown, which is one of the reasons we truly believe this is going to be a pretty difficult bear market. So keep in mind, the Federal Reserve will not be there to bail us out, which is what we're used to. That's what we remember. So with that in mind, here's a few tips for you as we go throughout the bear market. Number one is don't panic. If you're an SCM client, the losses that we've endured so far are well within the plan. That was designed. The models are acting exactly as we would expect. We've seen the process in motion where each of our investment models are designed to lose a certain percentage. We're well within those parameters. And we've already taken action. We've taken as much money off the table as possible. Now, that doesn't mean we're not going to have some more losses. We're going to, when the data says to buy, we're going to buy, and we might lose a little bit more. But everything that's happened so far has been part of the plan of each model. But more importantly, it's part of your overall financial plan. The portfolios that we've put you in are designed to work with the financial plan, the cash flow strategy, and each individual investment objective for that account. So we've designed it to handle a bear market. That's one of the primary things we look at is what type of loss can we withstand? And then we use our engineering process to do that and invest accordingly. So number one, don't panic. Number two, and I think this is very important, ignore the media. Every time we have a bear market, you're going to see the media and people getting on there whenever there's a rally saying, see, the worst is over. The problem is these people always say that. They say the same thing over and over again. I'm paid to watch the financial media. I'm paid to read all the articles from these experts. That's my job, to see through it and see if there's any merit to what they're saying. We're focusing on the data, not what they say in the media. The last two bear markets, we've seen huge rallies, and every time the media says the worst is over, do not listen to them. Thirdly, be patient. This is really important because remember, 18 to 24 months, even if it's shorter and it's 12 months long, it starts to wear on you to see your account underwater, to see it not really going up and not really recovering. You've got to be patient. Because just as bull markets are created with excesses to the upside, during a bear market, we see excess losses to the downside. This creates opportunities where when enough people panic, we're going to be able to jump on board. But the only way you can do that is to have cash available on the sidelines and to have a data-driven process and a plan in place to take advantage. Trust me, I've been doing this for 25 years. SEM has been around for over 30 years. The best buying opportunities come when everybody is the most pessimistic. So if you're thinking that you're going to just pull your money out of your account and sit on the sidelines And when you think the worst is over, you're going to get back in. That fails time and time again. I do this for a living. I watch it every day. Every time we've had the best buying opportunities, my brain has said this is a really bad idea. But our data-driven process is designed to see without our emotions when the buying opportunities are there, and they will be there. We're going to have a huge bull market, both in bonds and stocks again. Trust me, we just got to get through this. So again, don't panic, ignore the media, and be patient. That's going to be the key no matter how long this bear market lasts. Don't panic, ignore the media, and be patient. We're going to be here throughout, however long this lasts, however deep it goes. And here's the beauty of it all. If I'm wrong that this is a bear market, we have a plan to put all of our assets back into place, and all we've lost is a little bit of time. Thank you for your trust. Please stay tuned to all of the different resources we have, the blog, this YouTube channel, and our social media for additional updates.